that investing is only for the wealthy or those with economics degrees, but the truth is quite different. Smart investing depends on understanding a few simple principles and applying them consistently over the long term. The first and most important piece of advice is to start early. Even if you only have a small amount of money, time is your strongest ally, thanks to the power of compound interest. The money you invest in your 20s can grow significantly compared to what you invest in your 30s or 40s. Another equally important piece of advice is, don't invest in something you don't understand. Don't follow trends or buy stocks simply because they're popular on social media. If you don't know how a company makes its money or what its future prospects are, you're putting yourself at risk. Educating yourself about the companies you invest in helps you make smarter, more confident decisions. Also, never try to time the market. No one, even professional analysts, can accurately predict when the market will rise or fall. It's better to adopt a strategy known as systematic investing or dollar cost averaging, in which you invest a fixed amount on a regular basis, regardless of market conditions. This method reduces risk and protects you from emotional decisions. Another essential principle is diversification. Don't put all your money in one stock or asset class. Spread your investments across multiple categories, such as stocks, bonds, real estate, and even cash. Diversification protects your portfolio when one sector declines. Also, remember to avoid high-interest debt at all costs. There's no point in investing and earning a 10% return if you're paying 20% interest on your credit card. Pay off your toxic debt first before you start investing seriously. Most importantly, invest in yourself. Learn a new skill, read books, attend workshops, and continually develop your capabilities. The more knowledge and skills you have, the greater your chances of making money and building wealth. Finally, be patient. Investing is not a get-rich-quick scheme. True wealth is built over many years. You will experience ups and downs, gains and losses, but those who stick to the plan and control their emotions are the ones who ultimately succeed. These timeless investment principles have changed the lives of millions, and they can change yours too. Investing success isn't about luck. It's about discipline and consistency. Be wary of commissions and hidden fees. Many people start investing through brokers or mutual funds without paying attention to the monthly or annual fees. These fees, although seemingly small, can eat up a significant portion of your long-term profits. Therefore, always check the details of any platform or fund before investing, and look for options that offer low or no fees. Don't be a victim of emotion. One of the most common mistakes new investors make is making decisions based on fear or greed. When the market is down, some panic and sell at the worst time. When it's up, they rush into buying without research. The market moves cyclically, and discipline is key. Stick to your plan and don't let emotions control your decisions. Monitor your lifestyle. Investing isn't just about putting money into stocks or real estate. It starts with your daily habits. Reduce unnecessary spending and save a fixed percentage of your income each month. Every dollar you save can be used to build a stronger financial future. Always live below your means, not on the edge. Set a clear financial goal. Before you start investing, ask yourself, why am I investing? Is it for early retirement, buying a house, or your children's education? Having a clear goal helps you choose the right type of investments and determine the risk you can tolerate. Learn the basics of financial analysis, even if you're not an expert. Understanding basics like the price-to-earnings ratio, P/E ratio, earnings per share, EPS, and debt can give you a clearer picture of the companies you invest in. Don't rely solely on the recommendations of others. Base your decisions on knowledge. Build an emergency fund. One of the biggest mistakes is putting all your money into the market without having enough cash reserves to cover 3 to 6 months of expenses. Life is unpredictable, and you may need emergency cash at any moment. Having an emergency fund provides security and prevents you from withdrawing your investments at the wrong time. Don't compare yourself to others. Everyone has a different financial situation, different goals, and different risk tolerance. Don't be discouraged when you see someone making quick profits. And don't be fooled when you see yourself ahead of others. Investing is a personal journey, and focusing on your own progress is more important than any comparison. Invest in productive assets, not just in things that appreciate in value. Dividend-paying stocks, rental properties, or even income-generating side projects are better than simply buying something and hoping its price will rise. Regular income brings stability and reduces your dependence on market fluctuations. Stay informed. The world of investing is constantly changing, and the economy is affected by global events. Follow the news, read analysis, and learn from experts. But be careful not to be influenced by everything you hear. Always be critical and critical. The power of automatic saving. One of the most effective ways to build wealth without realizing it is to make saving and investing automatic. Set up your bank account so that a portion of your paycheck is transferred directly into an investment account as soon as you receive it. When saving becomes an automatic habit, the chances of hesitation or random spending are reduced. Approach the market with the mindset of an owner, not a gambler. When you invest in a company, imagine that you are buying a part of it and becoming a partner in its success or failure. This perspective helps you be patient and confident. Rather than thinking about stock prices and momentary market movements daily, set aside time each month to review your financial situation. Don't let your investments run on autopilot without monitoring. Set a monthly deadline to review what you've invested in, what's yielded good results, and where you can improve. Regular review gives you greater awareness and helps you make decisions based on reality, not impressions. Don't neglect retirement, even if it's far away. Many young people think that planning for retirement is too early, but in reality, it's one of the best financial decisions you can make at an early age. Every year that passes without investing in a retirement plan means additional years of work in the future. Invest today to buy your freedom tomorrow. Understand the difference between assets and liabilities. Simply put, an asset is what puts money in your pocket, and a liability is what takes it out. A new luxury car may look attractive, but it deducts taxes, insurance, and maintenance, while a good stock or rental property may be an income-generating asset. Focus on accumulating assets, not depreciation. Don't ignore taxes. The true return on any investment isn't just what you earn, but what's left after taxes. Learn your country's tax laws and take advantage of tax-deferred or tax-exempt accounts like a Roth IRA or 401k in the US. Smart tax reduction can save you thousands of dollars. Invest in financial technology. Today, there are tools and apps that help you analyze your portfolio, track spending, receive alerts, or even automatically allocate assets based on your goals. Don't neglect these tools. They make things much easier and save you a lot of time and effort. Learn from your mistakes, and don't be ashamed of them. Every successful investor has made them. Separate passion from facts. In investing, being excited about a company or project doesn't necessarily mean it's a good financial decision. Learn to separate what you personally love from what is supported by numbers and analysis. Don't fall into the trap of emotional attachment to a particular stock simply because it belongs to a field you love. Don't chase quick profits. Any opportunity that promises a big return within days or weeks is often high risk or even a scam. Real investing is a marathon, not a sprint. Be patient with your results, invest consistently, and you'll find that real returns come with time. Treat every dollar like a soldier in your army. Every amount you have is a tool that can work to your advantage. Don't waste it on frivolous expenses or immediate consumption. Always ask yourself, will this money build an asset for me? Will it increase my cash flow in the future? If the answer is no, reconsider. Continuously develop your financial intelligence. It's not enough to know the basics of investing. Keep learning. Read books like The Intelligent Investor, follow economic reports, and watch interviews with successful investors. Every new piece of information can be a turning point in your thinking. Know your risk tolerance. Not everyone copes with market fluctuations in the same way. Some collapse at the first loss, while others remain resilient even in the worst times. Define your financial personality and build your portfolio in a way that suits you psychologically, not just mathematically. Don't invest everything you own at once. Even if you're confident in a particular opportunity, maintain a certain amount of liquidity. The market is full of surprises, and unexpected opportunities may arise, or you may need emergency funds. Liquidity gives you flexibility and prevents you from making decisions under pressure. Participate in communities interested in finance and investing. Being surrounded by people with similar interests opens new doors to knowledge, discussion, and motivation, whether in online groups or in real-life meetings. Your environment directly influences your decisions and growth. Invest for freedom, not just money. The goal of investing isn't just to have a huge bank balance, but to reach a point where you don't have to work for money, to own your time and choose what you do, with whom, how, and when. Money is a means, not an end. Test your decisions on paper before you implement them in reality. Before you make a new investment, try writing a scenario. What if I win? What if I lose? How much can I afford? What's your plan B? These simple questions can save you months of regret. Make sure you develop multiple income streams. Don't rely solely on your salary. Consider ways to build additional income streams. Investing in a small business, income from writing, training, or any skill you have. Multiple income streams are one of the most powerful weapons for financial freedom. Would you like to compile all the tips I've provided into a single PDF or video script? Or start a new text in a different direction, such as investing in real estate, or how to build your first investment portfolio?